You swipe a credit card, and the payment goes through in seconds. It feels like money moving from your account to the store. But that's not what's happening. The store doesn't get your money. They get someone else's. And between that swipe and that deposit, 4 different companies take a cut you never see. Every credit card transaction is a miniature loan that gets packaged, verified, and settled through a chain of financial intermediaries. When you tap your card, you're not paying the merchant directly. You're triggering a request that bounces between your bank, the merchant's bank, and the card network, all within 2 seconds. Each entity in this chain provides a service: verification, risk coverage, infrastructure, fraud protection, and each one charges for it. The fee gets split up so quietly that most people never realize it's happening, but it's always there, built into the price of what you just bought or taken directly from the merchant's revenue. This system isn't hidden because it's shady. It's hidden because it's designed to be invisible. Let's break down what actually happens when you use a credit card. Your bank, called the issuing bank, and the merchant's bank, called the acquiring bank. Between those two banks sits the card network: Visa, MasterCard, American Express, Discover. When you pay for a $100 coffee maker, the merchant doesn't receive $100. Depending on their agreement, that missing $2 to $3 is called the merchant discount rate, and it's split between the card network, the acquiring bank, and your issuing bank. The process happens in 2 stages: authorization and settlement. Authorization is instant. Settlement happens later, sometimes days later. That's why a charge might show as pending before it clears. You tap your card. The terminal sends a message to the acquiring bank. The acquiring bank forwards it through the card network to your issuing bank. Your issuing bank checks: does this card exist? Is there enough credit available? Does the transaction look legitimate based on your patterns? If everything checks out, your bank sends an approval code back through the same chain. The entire loop takes about 2 seconds, but in those 2 seconds, your bank has just agreed to loan the merchant $100 on your behalf, even though you haven't paid them back yet. This is the core of the system. Your bank fronts the money immediately, then collects from you later. The merchant gets certainty, you get convenience, the bank gets interest and fees. Here's where the money gets split. Your issuing bank doesn't provide this service for free. They charge an interchange fee, usually between 1.5% and 3.5% of the transaction. On that $100 coffee maker, your bank might take $2. This fee is set by the card network, not negotiated transaction by transaction. It's a standardized rate based on factors like card type, merchant category, and whether the card was swiped, tapped, or typed in manually. Premium rewards cards have higher interchange fees because the bank needs to fund those cashback bonuses and travel points. The merchant's bank, the acquirer, takes a smaller cut, maybe 0.10% to 0.50% for processing the payment and managing the relationship with the merchant. The card network takes another small slice, often around 0.15%, for maintaining the infrastructure and brand. The merchant never sees this breakdown. They just see the total fee and the net deposit. Who benefits and who pays? You benefit from speed, convenience, and fraud protection. If someone steals your card, you're not liable for unauthorized charges. The system absorbs that risk. You also benefit from rewards, cash back, points, miles, which are funded by the interchange fees that merchants pay. Your issuing bank benefits the most. They earn interchange fees on every purchase, interest on any balance you carry, and late fees if you miss payments. The more you spend, the more they make, even if you pay in full each month. The card network benefits by processing billions of transactions globally. A tiny percentage of each one adds up to enormous revenue. The merchant pays the cost. On a $100 sale, they lose $2 to $3 immediately. For businesses with thin margins, gas stations, grocery stores, convenience shops, this fee is a significant expense. Some merchants set minimum purchase amounts or add surcharges for card payments to offset this cost, where legally allowed. Cash transactions have costs too: handling, storage, theft risk, bank deposit fees, but those costs are generally lower than card processing fees. That's why some small businesses prefer cash or offer discounts for it. But cash is disappearing, not because consumers demand it, but because card networks and banks have made cards more convenient, and merchants have absorbed the fees into pricing. Once cards became the default, the infrastructure became too embedded to reverse. Credit cards come with robust fraud protection. If someone uses your card without permission, the bank refunds you. But the bank doesn't absorb that loss. They pass it on through higher interchange fees and interest rates charged to all cardholders. The system is designed so fraud costs are distributed across the entire network. Merchants also share this burden. If they don't follow security protocols, they can be held liable for fraudulent transactions. This incentivizes everyone in the chain to invest in security. So why is the system built with so many intermediaries and fees? Because each layer solves a specific trust problem. You don't want to give your bank account information directly to every merchant. Merchants don't want to manage credit risk for every customer. Banks don't want to negotiate fees transaction by transaction, and nobody wants to wait days for payments to clear. The card network acts as a trusted intermediary. Visa and MasterCard don't issue cards or make loans. They provide the rails, the infrastructure that allows thousands of banks and millions of merchants to transact securely in real time. For that service, they charge access fees. The interchange fee exists because issuing banks take on risk. When they approve your transaction, they're guaranteeing payment to the merchant even though you haven't paid them yet. If you default, they lose money. The fee compensates them for that risk and for providing the credit in the first place. Rewards programs exist because they drive spending. Banks know that people with rewards cards use them more frequently and charge higher amounts. The interchange fee covers the cost of the rewards and still leaves profit. It's not generosity, it's customer acquisition and retention. From the system's perspective, this setup works. Consumers spend more with cards than with cash. Merchants gain access to customers who don't carry cash. Banks profit from every transaction. The fees are invisible enough that they don't stop the behavior. This is why everything costs slightly more than it would in a cash-only economy. Merchants don't eat the processing fees. They build them into prices. That 100 coffee maker might cost 97 if the store didn't have to pay card fees. But since most customers use cards, the fee gets distributed across all prices. It's also why premium credit cards offer extravagant rewards. Those airline miles and cashback percentages aren't funded by the bank's generosity. They're funded by merchants through higher interchange fees and by other cardholders who carry balances and pay interest. And it's why small businesses sometimes struggle with card payments. A local coffee shop operating on 10% margins loses a meaningful chunk of revenue to processing fees. Larger retailers negotiate better rates because they process higher volumes, but small merchants pay the standard rate. The system doesn't feel unfair because the fees are hidden. You never see the interchange charge itemized on your receipt. The merchant absorbs it silently, and you enjoy the convenience without thinking about the cost embedded in the price. Once you see this, you stop thinking of credit card payments as simple transfers. They're short-term loans packaged inside a trust network, with every party taking a cut for the service they provide. That swipe isn't just convenience. It's a financial transaction involving 4 entities, 2 stages of processing, risk assessment, fraud monitoring, and invisible fees built into the price you pay. The speed and ease you experience are the product of a system designed to make all of that complexity disappear. This isn't about whether credit cards are good or bad. It's about recognizing that every time you tap to pay, you're activating a machine built on intermediaries, incentives, and fees that no one ever mentions at the checkout counter.